Well, good morning. Hope your day is off to a good start. You know, now that the groundhog saw his shadow, we know we're in for 6 more weeks of winter. Now, there's a surprise. I'll have more to say about that later. But our show today is not about groundhogs or the weather. It's about how we should manage our money. I think we picked the right week for that subject. It starts right now.
From TV6, this is The Ryan Report. Here's your host, Don Ryan.
Well, we all work hard to earn our money. Most of us do it 1 hour at a time. At least that's the way they pay us. We've been taught that we should put aside at least a little to save for the future, for a rainy day, a kid's education, special project, or our own retirement. But that always raises the question of where should we put those savings? Invested wisely and the money can grow. Make the wrong decisions and that hard-earned cash can disappear. There are no simple answers, and we can't tell you specifically what you should do. But we can give you some things to think about. Joining us to provide some professional advice is Rich Tegge. Rich is the president and owner of Wealth Strategy Group in Marquette. Rich, welcome to the Ryan Report.
It's nice to see you, Don.
Good to have you with us.
Thank you.
Let's give people a chance to get to know you a little bit. Where would you call your hometown?
Well, my parents both grew up in Iron River, Michigan.
Okay.
And my dad then entered the service. I kind of grew up a variety of Air Force bases along the East Coast. Okay. And eventually put in for Sawyer. Retired out of Sawyer, so I was a model towner for my middle school years, and then we moved down to Kingsford and graduated from Kingsford. So I have the honor of being both a flivver and a model towner.
Yeah, that's a pretty good combination.
Yeah.
They both have some connection with some early pioneers in this country.
Yep.
You not only went to NMU, but you were a member of the football team.
Yeah, I was a member of the team in the early 80s, from 80 through 84 seasons. We had a lot of success back then, some great coaches, and a lot of things from my own personal development come from those days, and some of my best friendships, of course, were on the gridiron.
Did you have your eye on kind of a financial career when you went to school?
You know, in the beginning, it was kind of, I was going to play football, right? And as I got through the business courses, I found that the marketing and finance, those two pieces together were kind of where I wanted to go. And early on, I relocated to Florida. There wasn't a lot of opportunity in the Upper Peninsula. And at that point in time, I got engaged with Norwest Financial. Did several years with them before starting a company down in Florida.
Okay. And at one point, you started a company and you were the co-developer, and you wound up selling that company. What
Yes.
was that all about?
Yeah, it was the early days of the mobile office.
Okay.
And laptop computers didn't have the CD-ROM drives inside them and their modems and all that kind of stuff. It was early on. And so what we did is we took all those disparate pieces and tied them together into what was called a mobile office. Did that when we were working with Progressive Insurance, and then we took that product on to ADP and others in the automotive claims adjuster business. And then we were acquired by a company out of Canada, a publicly traded company there. I had a 3-year employment contract, and they moved me out east for a few years, and then when that was over with, that was the opportunity to return to the UP.
And you worked for a lot of different companies, not a lot, but several different companies in that period.
Yep.
Then you decided you wanted to start your own, right?
Yeah, when I came back, I started out with Edward Jones because I wanted to get into the investment piece, and I'd learned a few different things in running my own business. After a couple of years there, I went over to the Smith Barney office in Marquette, ran that until they asked me to close the office in 2008 during the tumultuous times. And that gave me the opportunity to make the move that I was already planning on, and that is to create my own investment firm here in the UP.
Okay. A couple of points I want to make at the beginning. Number one is we're not here to give specific financial advice over the
No,
air.
sir.
That's not the way to do it, right?
Correct.
We want to give people some things to think about. And there are other financial planners, obviously, around the UP, and it's important that people work with someone they're comfortable with.
Absolutely. Engaging somebody that you're comfortable with and help you navigate through life from a financial standpoint is very important.
Okay. Now, big elephant in the room. You know, we set this interview up not knowing that this was going to be the week that was as far as the stock market goes.
Yep.
And by that I mean, the market for over a year was pretty much straight up.
Yes.
Everybody was pretty excited. And this was the week, in one day it set a record for a decline in the number of points. And we're not sure how this week is all going to sort out, but how do you react to that, and how do you work with your clients during a week like this?
You know, the key piece in an event like this is to stay calm. Like you said, the past year, better than a year, we've seen very limited volatility, those big up and down swings that we are accustomed to in the market, that we were accustomed to in the past. And that kind of gives us a false sense of security. And so you have an extreme volatile situation that started last week and then continued into the first part of this week that can be a shock to the system, right? You're used to this standard steady climb, and then all of a sudden you have this big downdraft. And what we're telling clients is to stay calm. There are normal corrections that happen in an advancing bull market, and they can be 10 to 15%. They can come very, very fast, or they can be slow and gradual. But we see that the backdrop to what's going on in the country, both tax cuts and deregulation and this whole global expansion that's beginning to happen, as a long-term positive. But we're going to see shocks to the system like we're experiencing right now.
You know, and when you talk about that, if you watch the business shows on cable channels, and I'm sure a lot of people do, they always want to pin it to, well, this happened because. Yep. And I heard an interesting discussion one day that really doesn't work that way. That's kind of the media picking out that this is what happened. But in this case, in some cases, these things happen because of negative things going on, like, for example, with the mortgage crisis back in 2008.
Absolutely.
But in this case, it's almost like it was triggered by good news.
Yeah, you know, the issue that they're kind of pointing to is this fairly good move that happened in the Treasury rates, the 10-year Treasury yield. And for a lot of retirees, they've had to move out of these short-term CDs and government type issues into the market in order to get any kind of return because it's been so low and the government's been kind of holding it down. So we have a spike up in that rate, and that sends a little bit of a shock. We had some things that were reflecting increases in wages that about a 2.9% rate, which is a sign of potential inflation. So you have a couple of those things that come together, and for lack of a better term, there's an excuse to get out of the market for some. And once you begin to hit the exits, you get a variety of folks that follow.
Okay. We've got to take a break here. We'll be back with some more questions for Rich in just 2 minutes. Our guest this morning is Rich Tegge from Wealth Strategy Group in Marquette. Before we went to the break, we were talking a little bit more, talking about what's gone on this week. And for example, they had a positive jobs report, and then they're concerned about inflation, and then they're concerned about what the Fed is going to do. Again, these are all just kind of triggers, right? And they're really positive developments.
Absolutely. Yeah, the market can react in a lot of different ways depending on the news and we're in this high-powered news situation now where everything is instantaneous. So any kind of little blip that happens out there can be a significant market reaction to. And what I'm telling clients and other advisors are advising their clients, these are moments to just be calm. There are times that we look at and evaluate, the overall plan. But in shocks like these, this is just noise in an overall plan.
Now, some people would say this is a buying opportunity. Do you look at it that way?
I do, but it depends on the individual, correct? Everybody has a plan and has a comfort level with being in the market. And some folks just aren't ready to step back in these heights of volatility. But the old saying is the best time to buy is when there's blood in the streets, right? Yeah, right. And so, yes, these can be buying opportunities. Sometimes we're not exactly sure if we're getting the exact bottom, and that shouldn't always be the worry. The key is when you have dollars to invest and there's an opportunity and it makes sense for you and your plan, yeah, put that money to work.
How do you go about working with your clients?
Well, first of all, you have to really understand the individual and or couple with what their objectives are, where they are in their life, what kind of things they're looking to save for. We always talk about saving for retirement because that's kind of that long-term piece. And sometimes that gets lost in the day-to-day as we're raising children, things like that. And so everybody has their own specific needs, own specific issues, and it's a matter of sitting down and understanding those, understanding where they are today, and then really getting a good picture of where they want to be come retirement time frame. And then building a plan or a roadmap that connects those 2 points.
Do you feel that each individual probably has some different ideas then, or some different needs?
I think so. I think, you know, every advisor, you know, draws on their own experience. And so, as with every client, they're drawing on their own experience. So, you know, what you're searching for is the right level of comfort that they're going to have with the plan that you put together, and the instruments that you use to help them achieve their goals.
Obviously, for your business and for any financial planner, it kind of depends on your being able to place people in certain kind of investment accounts. But do you see yourself as more than that? Or, for example, I noticed in one of your reports you talked about not going into retirement with debt. Well, you know, that's kind of financial advice, or good sound
Correct.
advice, I guess.
Well, I think there's a lot of leadership that we can provide for folks in my business, and a lot of it is understanding, you know, the good things that people are doing and some of the mistakes that they're making. Like you said, in regard to debt and retirement, you know, when we go to retire, we're on a different cash flow situation, and it's a limited income piece. Do we want to be driving that towards debt, or do we want to be driving that towards our lifestyle? I'm recommending that clients retire that debt so that that extra income that they have is going to the lifestyle that they're looking to achieve rather than servicing the debt.
Do you take into consideration, as you're helping people develop these plans, things like Social Security and 401ks and IRAs and all the rest of it?
We have to look at their full picture, right? And there's a lot of different income sources that somebody may have. They may have you know, rental income. They may have a business that they sell. There's a lot of different things. They may decide to continue to work. We're working with a lot of clients that, you know, will be working part-time in retirement because they want to stay active and they enjoy that. Some are starting a business. So you have to factor those things in and understand how their Social Security is affected by those situations, and how each of those pieces of income, whether it's drawing off of their 401k or an investment account, those kinds of things, how those pieces come together to build that income for them most tax effectively.
Is it a big issue with many people to get them to understand that you've got to save some money? You know, we all kind of want to spend what we have.
Absolutely. I was sitting down with somebody this morning, right? And you know, their circumstances had changed, and they were trying now to build back the retirement savings. And so, you know, there's a lot of different events that happen throughout our life. You know, for example, just raising children. You know, all of a sudden it's like I've got to put all that investment into my kids now to get them through school and all the different things that they want to do. But yes, we have to find a way to carve out some of those savings for that longer term, and sometimes it's a challenge. People understand that they need to be doing it. It's just not always easy. So our job is to try and help them find ways to get those dollars to save.
Okay, we'll talk about some of those ways in just a minute. Back with more on the Ryan Report after we take this commercial break. Once again, our guest this morning is Rich Tegge with the Wealth Strategy Group. You know, talking about retirement planning, one thing that I believe has changed, and not just recently, but that life expectancy has really changed that investment strategy, hasn't it?
It really has. And you know, we talk about retirement planning. It's really it's a new thing. You know, until Social Security kicked in the early 30s or mid to late 30s. We didn't talk about retirement planning. People just worked their entire life. I mean, it was kind of the way it was. Yeah. So the whole retirement planning thing has evolved, and you know, as we look going forward, the process by which we look at things and how we save now has to take in this longer lifespan. And you know, when Social Security went into effect, average lifespan was 63 years of age. Now we're talking 78. So
and a lot of people living well beyond
that. A lot
that.
Longer than that. Yeah, we're planning for people living into their 90s now. And so how do you do that? How do you make sure that people understand that this income stream has to survive 25, 30 years potentially for them?
And it used to be you get into your late 50s and you pretty much put everything in pretty conservative investments that weren't going to grow very much.
Oh yeah, the whole piece of how we invest in retirement has changed. It used to be your age minus 100 was what went into the equities, right? So if you're 70, you had 30% of your portfolio in stocks. that's, that whole rule of thumb has changed. And so we have to plan for that longer lifespan. And people are beginning to work longer too. And we're healthier, at that later age too.
The other thing that's happened, and I'm well aware of this, but
Yeah.
for those people who are retired and a little older, it's been difficult to find a conservative investment that really works, because in the old days when you could put money in a CD for 7 or 8%, we haven't seen that in forever.
Imagine the challenge on my side.
Yes.
Yeah, as we look at those things. Finding those good conservative investments for our retirees is a challenge for advisors. And so, part of it is counseling them on, being able to take less off of their retirement investments than they were possibly used to. But the days of the 6%, money market fund is gone for now anyway. Yeah. And so it poses challenges in that conservative portfolio. So we have to look at other strategies that allow us to beat inflation over time, and still, not put shocks to the system for that investor.
For a lot of years, the mutual fund became the prime investment, and probably still is for a lot of people.
Yep.
Now we have something called ETFs. Tell people what they're about. And they're not new, but they're relatively new.
They're relatively new, and a lot of new money, as far as new investment money, is going into exchange-traded funds. They generally are a low-cost investment alternative that invests you across an index. For example, the S&P 500 index, maybe one that you would be looking at to get broad market exposure. But they trade like a stock. You can buy and sell them during the opening of the markets. Where mutual funds, they close out at the end of the day and reprice at the end of the day each day. So you can't, after 4 o'clock, you can't buy or move into a new mutual fund until the next day's close. And so it's an open-ended investment, but it is different in how they are purchased and managed relative to buying timeframes on the market.
There are all kinds of other investments like derivatives, and do you get into those kinds of things?
We stay with what we understand,
right,
and we stay with what we can explain to our clients. And really, there's a lot of very unique specialty type items that the average investor, probably shouldn't be in. Okay, but the key is to understand where and how you're invested,
right,
and be comfortable with it. We talk at my firm about clarity and confidence. Being clear on what you own and why you own it, as to how it's helping you achieve your goals.
And then there are things like Bitcoin, which I have no clue what it even is.
The cryptocurrencies, as they call them.
Right.
It's that's a whole market that's yet to be defined. I think there's a lot of speculation there, and it should be something that if you're going to look at an investment in something like that, make sure you do your research and make sure you're working with a reputable firm.
And that is more like going to the casino, isn't it? And this, right now, at least.
Today, I believe so. Yes, yeah. I think it's a big risk. We've seen it get up to around 19,000. I think today it's 7,000 or 8,000 per Bitcoin. So extreme volatility, and with volatility in our business, that's how we quantify risk. Okay. And so I would say it's fairly risky to be in that today.
We have less than a minute. What closing thoughts would you have for people sitting out there thinking about their money?
Well, I would tell you right now, with the volatility that we're seeing in the market, these huge swings, just to step back from the edge and be comfortable. Don't get worked up about it. If you've got a plan, stick with your plan. If you don't have a plan, engage an advisor to sit down and talk about your situation, what your goals are, and they can help you define some of those, and get on a plan that helps you reach those goals. Because in retirement, we want to have the choice of enjoying a lifestyle that we hope for, not one that we settle for.
Okay, very good. Thanks for coming in. As I said, it was an interesting week to be talking about this subject. I'll be back with some other thoughts for you in just a couple of minutes. Another special day on the calendar has come and gone, as I mentioned earlier. We've now been witness to another Groundhog's Day. I don't think this observance has ever meant a great deal to the average Yooper. We may observe it with the rest of the country, but we don't have a lot of faith in the groundhog's weather predicting skills. As we all know, legend has it that if the groundhog comes out of his hole and sees a shadow, we can look forward to another 6 weeks of winter. Most of us who live here can be pretty certain that no matter what the groundhog sees or doesn't see, we have a lot more than 6 weeks of winter ahead. In case you're wondering how this celebration started, it can be traced back to Europe and the ancient Christian celebration of Candlemas Day, the halfway point between the winter solstice and spring equinox, when clergy would bless and distribute candles needed for winter. In Germany, they added something extra when they used a hedgehog to predict the weather, and thus we have the 6 weeks of bad weather idea. When many Germans came to this country and settled in Pennsylvania, they brought that tradition with them, but they adopted the groundhog as part of their tradition. So in 1886, a newspaper called the Punxsutawney Spirit published a story about the groundhog festivities. The next year, the city embraced the celebration and held the first Groundhog Day at Gobbler's Knob. It's been going ever since. So here's a thought. Perhaps it's time we started our own tradition, something that would have more meaning to the people in the Upper Peninsula. Suppose we say, when Green Bay Packer fans realize their Super Bowl hopes are over, Upper Michigan can expect at least 6 more weeks of winter. When Detroit Lion fans realize they're out of the running for the Super Bowl, the start of winter is still a few weeks away. I know those are fighting words. I can say it, however, because I've been a Lion fan longer than most of you have been alive. I remember Bobby Lane and Doak Walker. Of course, it's going to change next year. Where have we heard that before? In any case, Groundhog's Day is over. Those folks in Punxsutawney, Pennsylvania can look forward to 6 more weeks of winter, and one day we can look forward to April's showers. The only question is, will they be rain or snow? I'll be back in a minute. Time for us to wrap it up for another week. The Today Show is just about set to go. Remember to keep UpperMichiganSource.com in mind for the latest news anytime. You can also see this show at that same address. Thanks to Rich Teggy for joining us this morning to share some ideas about managing our money. And thank you for being here. Let's make a date to get together again at this same location next Sunday morning.